Yo, what is going on, SoFi investors? My name is Jason, and today we're going to talk about some SoFi stock. We're going to get into some of the interviews that Anthony Noto did on like CNBC and some other networks. Man, today the beatdown continues. We're down to $6.80 per share. In my video I did yesterday, I said we could probably dip to around 650. We hit 666 and then bounced off of that. And we've been slowly moving up towards $7 the rest of the day. Can we hit $7 today? I doubt it. We'll have to see how the rest of the week goes and see where SoFi stock bottoms. I bought 200 shares in my big dog account. So the big dog account's up to 3,500 shares. This little baby account's got 205 shares in it. Our average is around $7.55. So let's watch this interview with Anthony Noto and see what he has to say about guidance, which was weak, and that's why I think the stock sold off, and how he talks about Q1 and the performance from SoFi. All right, let's get into it.
Joining us now exclusively is SoFi CEO Anthony Noto. Anthony, welcome back. Good to see you.
Good to see you as well.
So why is the stock down 9% despite a strong increase to guide? What is the street taking from this?
Yeah, I think it's important to focus on the results and what that means for the full year and then what that remains for our 3-year outlook. So in the quarter, we achieved 26% year-over-year growth in revenue, $581 million. We had 25% EBITDA margins. We grew that almost 100% at $144 million. More importantly, we have grown tangible book value per share 16% sequentially by about $600 million. We had record deposits of $3 billion and really strong overall performance.
With that 26% revenue growth, $581 million, 25% EBITDA margin, almost 100% year-over-year growth, and then the tangible book value per share went up 16%. Real quick, if you don't know what that is, tangible book value is the amount of money an investor would receive for each share if a company were to cease operations and liquidate all its assets. For most people, tangible book value is very important because it kind of mitigates some of the risk. And a lot of investors base price point on where they're going to buy the shares at with tangible book value. As that increases over time, SoFi, therefore, becomes more and more valuable. All right, let's continue.
The most important thing about those trends that I'd point out, and the reason why 2024 is a transition year, is the growth was driven by low capital, high return businesses, our technology platform business, and our financial services businesses. Those two businesses, when combined, grew 54% year over year against lending that was flat. As we came into 2024, given the uncertainty in rates and the economy, as well as liquidity for the industry, not us, and despite having excess capital, we made the decision to put the resources behind these high return businesses that actually are big enough now to drive our overall growth and profitable enough to do that. And so that's the key message coming out of the quarter, is that transition is taking place and going incredibly well, which sets us up for a great 2024.
Anthony Noto was talking about how 2024 is a transition year. Lending used to be like 80% of all the revenue for SoFi. But now the tech platform and financial services, those two combined are about equal with lending, which is really good for a diverse business model. They're low capital, high return businesses, and they're deciding to put a lot of their excess capital into those businesses, while lending has so much uncertainty with interest rates and the economy and all this craziness going on with the wars overseas. And I really think investors need to get out of this bro mindset that we're going to go to the moon in like 6 months, 3 months, a year even. That's not really how investing works. That 2020 trend is not reality, right? So this is for the long term, and Anthony Noto is setting up the business for the long term. Being cautious when you want to be cautious, when you need to be cautious. And then ramping it up when things start to improve macroeconomically. I think he's doing a really good job. He's being a responsible CEO and setting up the foundation for this business to really grow in the next 3 to 5 years. And that's what I'm looking forward to. That's why I'm an investor in SoFi. All right, let's get into the rest of this interview.
We actually raised 24 revenue guidance by more than our beat. The comparison to Q2, we'd not provided Q2 guidance before. The street had an estimate there that was above what we guided to, but for the full year, estimates will be going up relative to consensus by more than our beat in Q1.
Okay, so thanks for clarifying all the expectations game. What can you tell us about credit quality right now for borrowers?
Yeah, what we've said is that credit will normalize back to pre-COVID levels, and we're on track to do that. Our life of loan loss targets for our unsecured personal loans are 7 to 8%, and we remain comfortable with those expectations. We are higher in credit than most. We focus on prime credit, and we have very high FICO scores and good cash flow ratios when we underwrite credit. But we've taken a more conservative view on credit, primarily because of the fact that it's not clear where rates will go. At one point last year in October, people were talking about higher for longer. Then by the end of the year, they were talking about 6 rate cuts, and now we're looking at 1 to 2 rate cuts. That type of volatility and uncertainty creates a backdrop that we think allows us to be more conservative in lending and much more aggressive in technology platform in our financial services business. A lot of people don't realize that in our financial services business, we have SoFi Money, SoFi Invest, SoFi Insurance, SoFi Credit Cards, and a few other high margin businesses. And that's now profitable, which allows us to scale that acquisition. And that's what's driving our 44% growth in members to 8.1 million now and almost 12 million products.
Anthony, there's been some dissection of the eco data, the macro data last few days, specifically the saving rate going to the low 3s. And some argue it's a sign of stress, that consumers are sort of living on the edge. Others argue this is all about the boomer generation spending every last penny of their nest egg. Do you have any idea what's going on?
Well, we definitely have a member base that's saving. Our deposits grew a record $3 billion in the quarter. We provide a very attractive interest rate of 4.6% on your savings with direct deposit or with a large recurring deposit on a monthly basis. So we're seeing great trends there. And it's not just the growth in deposits, it's also the growth in spending. We had about $1.8 billion of debit spending on the platform, up from the low $1 billion last quarter. So we're annualizing about $8 billion now. And again, that's on a member base in SoFi Money that's at 3.5 million.
I hope you all got something out of that Anthony Noto interview, and I tend to agree with pretty much everything he's doing right now. If I was running this business, I would be really conservative too. As credit starts to normalize, their loss target on personal loans is at 7 to 8%, so we'll have to watch that going forward. And if the number ticks down a little bit, they can be a little more aggressive. But if it ticks up, they're going to have to continue to stay conservative. In my opinion, loan origination is going to be flat for the rest of 2024. I know you probably don't want to hear that, but that's just the truth. But financial services and the tech platform are kind of picking up steam, and they're going to make enough money to keep us profitable for the foreseeable future. And then once the environment gets a little better and we know where interest rates are going, probably 1, maybe 2 interest rate cuts in 2024. That's all we're going to get. But as we start to lower interest rates, SoFi can start to be more aggressive and ramp up giving out loans. Because obviously when you give out a big loan, the lower the interest rate, the lower monthly payments. Now with these extreme interest rates, paying back loans is really hard for a lot of people. That's why they keep their standards so high, and I really like that about SoFi. It's really hard to get a loan from them, which makes the chance of people defaulting on those payments a little bit better, in my opinion. All in all, I'm pretty happy with what Anthony Noto was saying. 44% new member growth, 8.1 million members. So we're going to add probably around 600,000 new members every single quarter now. So by Q4, we're going to cross 10 million SoFi members, which is really, really cool. The customer savings rate is going up, which is really good. $3 billion in new deposits is great. We just crossed $20 billion in total deposits. So if we can get $3 billion in deposits every single quarter and just adding to that nest egg, it just gives SoFi all this capital to originate loans. But we got to wait for the right environment. We can't rush into things. Then you're having a 10, 15, 20% default rate on these loans, and then you're just screwed. You're just stuck holding the bag, and you don't want to do that. You want to gauge the environment. You want to anticipate what's going on, but do it in a slow, conservative, responsible manner. And I think that's what Anthony Noto is doing. That's why I'm going to continue to add to my position of SoFi unless something dramatically changes. I like the trajectory of the company. I like where they're going. I think it's going to happen for SoFi. It just might take a little longer to get there with all the craziness going on in the world. All right, if you like these type of videos, make sure you hit that like button, subscribe to the channel. We appreciate you guys tuning in. Thanks again. Peace.